Confused about UK pensions and Australian super? Well, this video should help. Hi, it's Gareth Cable from Empire Wealth. Look, during this video, I'm going to give you a quick breakdown and help you to better understand these powerful tools for building your wealth, saving tax, and your retirement. Look, I've broken it down into chapters, so feel free to jump around to the different areas that interest you the most. I do need to keep the lawyers happy with this disclaimer. So the advice and information is general in nature and might not be appropriate for you given your specific circumstances. All care has been taken to provide you with accurate and up-to-date Australian and UK tax information as at November 2021. This should not be considered as a substitute for personal financial advice. Okay, we've got that out of the way, so let's get straight into it with a breakdown of the main UK pension funds. So as you can see here, starting down the bottom, we've got our stakeholder pension. Now these are usually the cheapest and have the least amount of investment options. Then we move up to group personal pensions. Now, these are the most common, whereby your employer has set these up on your behalf. They could have set up a stakeholder pension too, but most likely it's a group personal pension. These have more investment options than your stakeholder pension, and they tend to have reasonable fees because your employer will have done some negotiation with the provider. Now, if you wanted to set up your own, you can set up what's called a personal pension, which is the next level up. Now, these are usually allowing you to consolidate or move other pensions together. And they typically have the same investment options, or maybe even a few more than what the group personal pensions are. Now, moving up to the next level again is our self-investment pension plans, or SIPs as they're called over here. Now these are quite a big jump up, as they have tremendous capacity because they can actually hold, well, a lot of them can hold commercial property, and you can even do some lending to purchase that property against some of your pension funds. And also there's a whole range of investment options. So then we move up to the top pension there, which is called the small self-administered scheme. Now, these tend to be the most expensive options, and they can do everything that a SIP can do, but they can also perform some lending to assist with the business. Now, there's some really strict rules around that, but they typically are the most powerful. Okay, so let's do a quick comparison looking at Australian superannuation, or a bit of a refresher if it's been a while since you looked at them. So similar to a stakeholder pension in Australia, there's an industry fund. Now, it is again usually the cheapest. They used to have one of those kind of symbols that they do all the time just to help you to recognise it's an industry fund. And they used to also have the least amount of investment options, but there are some providers now that are really starting to expand that offering. So that's at the cheapest end. And then we move up to a retail super fund. Now these are similar to those group personal pensions and the personal pension that you saw previously with the UK pensions. And again, employers tend to have negotiated lower fees than if you'd set it up directly with the actual retail super fund. Then moving up to a super wrap account. Now they're not too dissimilar to a SIP, but they usually can't hold the actual properties on them. Although some self-managed super funds will actually have a wrap account in there, but typically not so much. And then we move up to the next stage again, which is our self-managed super funds and small APRA funds. Now, these give really extreme choice, flexibility, and you can usually hold properties within them, and they're very powerful tools, and again, typically higher balances in terms of utilising those particular vehicles. Moving on to UK pension and superannuation choice for your employer contributions. Well, in the UK, it's rare that an employer will allow you to choose which pension provider you'd like to have their particular contribution go into. Most of them have selected their particular pension provider, their preferred one, and you can't make any alteration to that. Whereas in Australia, it's actually written into law. Employers must offer eligible employees a choice of super fund to meet their superannuation obligations. Now, there might be some people that work within the public service whereby they might have to put money into a particular fund, etc., but it's something to be aware of. Next one's the default investment options. Now, most UK pension funds tend to be target dated or lifestyle funds. That means that most of them are designed to turn to cash by the time you hit your retirement age, with the intention of it being converted into an annuity, which is kind of almost like a term deposit, whereby it's a guaranteed amount each and every single month, etc. So something to bear in mind. With Australian superannuation policies, typically they default to what's called balanced, and that may be 60% in kind of shares, both Australian and like overseas shares, etc. Things and property, growth type assets, 60 to 70%, and then 30 to 40% in more of your fixed term type of investments. But that's a big difference as well in terms of what the defaults are. So it is worth reviewing these default options and ensuring that they do actually reflect what you're comfortable with in terms of level of risk. Maybe balanced is too aggressive, maybe it's too conservative. Likewise, with the target dated or lifestyle funds, they again might be too much or too little. And they might not actually be aligned with your retirement goals. Maybe you're wanting to retire a little bit later, or potentially you might be wanting to retire a little bit earlier. So it's well and truly worth reviewing those default options, because you don't want to get that wrong. Look, capacity to opt out. Now, this is an interesting one. In Australia, only high income earners with multiple employers can opt out, right? And that's opting out of concessional contributions. And we'll get onto that later. The government doesn't want high income earners to unintentionally go over their concessional contribution cap. Otherwise, it's compulsory for most other Australian employees aged 18 or above, irrespective of them being full or part-time, casual, or even if they're over there on a temporary basis, maybe on a working holiday, they'll still need super contributions. Now, there are some rules around that. Have a look in the link below if you're wanting to find out more. In the UK, everyone can opt out, although it's rarely a good idea. Where a little bit of confusion comes in is that auto-enrolment was introduced back in 2012. And all that means is that based on earnings and age criteria, an employer is obliged to set up a pension for the employee, and then it's up to the employee to either do nothing and they'll remain, or to opt out. Then, if they do choose to opt out, the employer is then obliged after 3 years to re-enroll the employee. But again, at that stage, the employee can opt out. Okay, moving on to contribution limits. So let's touch on those. In the UK, technically, there's no limit on how much you can put in. However, there is a lifetime allowance, and we'll get onto that in a minute. And there are limits to be able to receive extra money from the UK government, which is called tax relief, which is a foreign thought to most Australians in the UK. They're not familiar with what that term means, and that's what it means. It's virtually the UK government giving extra money, but there are also other tax advantages. And the maximum contribution benefit is £40,000 for this current year, and that's not for everybody, depending on if you're a higher income earner. And within that 40,000 includes that UK government tax relief. So that's the money that they're putting in. Now, there is capacity if you haven't utilised all of the previous year's allowances. You can go back and have 3 years worth of contributions that you could build up and make a larger contribution. Again, there are rules around that. So if you've had lower income years, well, then you can only put in as much as you've actually earned. So again, it's a slightly complex area. Have a look in the comments below to find out more. As mentioned, if you are earning more than £200,000 in what's called threshold income, and over $240,000 in adjusted income, you'll have what's called a tapered annual allowance. Now that lowers that £40,000 limit, and so for each pound, for every £2 that you go over that limit, it reduces it by £1. Again, check the links below for more details around that. The minimum that it will be reduced to is £4,000. Okay, Australian superannuation contribution limits. So in Australia, the contribution limits are actually broken into 2 types. You have concessional or pre-tax contributions and non-concessional or post-tax contributions. Now, the concessional contributions, these are contributions that are made before any tax has been applied to the money, and the limit is now 27,500 Aussie dollars for the 21-22 tax year. Now, while they provide you with a tax deduction for your Australian tax, they are taxed at a flat rate of 15% via the super fund when going in. Okay, so that's something to be aware of. And 2 quick things that most people aren't aware of regarding concessional contributions is, 1, when it comes down to spouse contributions, a lot of people are familiar with the spouse contributions. But if you do split that concessional contribution to your spouse, this will still form part of your contribution cap, not the spouse's, right? Secondly, with high income earners, there's what's known as Division 293. So if your combined income and concessional contributions are more than 250,000 Australian dollars, Division 293 may apply, which usually leads to an extra tax bill. So it's something to be very mindful of, especially if you've had a capital gains tax event, maybe you've had an eligible termination payment, things of that nature, and you've recently moved back to Australia, and that's something that's going to be a consideration for you. So now on to Australian non-concessional contributions. These are paid after tax. The maximum is currently 110,000 Aussie dollars, and unlike the UK system, it's actually a bring forward rule. So you're allowed to use the following year's allowances rather than the previous year's allowances. So you'd be able to make a larger contribution. Now, when it comes down to it, you need to be under certain age limits. It's from 65, it's creeping up to 67. So be very mindful about that particular rule. Maximum pension limits. So in the UK, pensions have what's called the lifetime allowance. Now that's currently £1,073,100. Now, this could actually be higher if you've previously applied for one of the various protections available to increase this allowance. So there was primary, enhanced or fixed protection. I'm sure you'd be aware of it if you'd had that applied, but there are still some other protections that are available. So anything exceeding these particular limits are subject to additional tax charges, and they're brutal. So on a lump sum, there is a 55% tax charge, right? Whereas on an income stream, if you were to go down that route, there is a 25% tax charge on top of any income tax you pay. So a lot of people are confused about that particular rule, thinking it's only 25% tax, but in actual fact, it's effectively a punitive tax on top of your income tax. So usually the result isn't too dissimilar to 55% tax for those higher rate taxpayers, and even more for additional rate taxpayers. So your question might be, when do they actually check these lifetime allowances? Well, there are several checks of compliance with the lifetime allowance. If you transfer a pension overseas before age 75, at that time, they will check against that lifetime allowance. If you reach your 75th birthday and you haven't touched your pension, that's when they'll check against that lifetime allowance. If unfortunately you passed away, at that stage, they'll check against the lifetime allowance. And when you start drawing down on your benefits, and obviously that can be from 55, it's gradually moving up to 57, they'll check at that stage. Usually after 75, there's no further checks, because you will have had one of those particular events occur and you would have had that assessed then. Now, Australian superannuation limits. Now, previously, and it'll come as a shock to some people that haven't looked at this recently, since July 2017, there are now actually two new, one's a cap and the other one is just a review of the balance to determine what you're entitled to. So you've got what's called the total superannuation balance. As I mentioned, that's to determine a fund member's eligibility for certain types of contributions. Then you've got what's called the transfer balance cap, and that is to determine the eligibility for tax exemptions for income earned on fund investments. So effectively, that transfer balance cap, you would have remembered there was two parts. So we've got the money as it's building up, accumulation, and then moving across into a pension. That's when you start taking the money out. Now, depending on your circumstances, that transfer balance cap and the superannuation balance, they will be somewhere between 1.6 million and 1.7 million Australian dollars. And to make matters worse, they're not necessarily going to be the same figure. So in the link below, you'll be able to calculate which cap applies and which particular balance applies on your particular circumstances. Now, if you exceed your personal transfer balance cap, you may have to commute. That is, convert a portion of your retirement phase income into a lump sum, right? And the excess from one or more of those particular pay tax on notional earnings. So this is when the Australian Tax Office estimates your tax by taking the investment income reported by your most recent tax return and applying current income tax rates to it that relate to that excess. Now note, during your pension or retirement phase, the value of the fund, if it grows through investment earnings, which are beyond your personal transfer balance cap, you aren't considered to have exceeded your cap. So effectively, if your limit was 1.7 million it's moved into that pension phase, and then through growth, it goes up to 1.8 million, you aren't considered to have actually exceeded your cap. You got in right on the level that was acceptable, and then you don't have to worry about it. However, if during this pension phase, the actual funds go down in value, and you'd got it in at 1.7 and then it dropped to 1.1, you wouldn't be able to top this up. So it makes it really important to actually keep on top of how those funds are invested, because you really only get one bite at the cherry if it drops in value. Okay, so now age to be able to access the funds. So in the UK, pensions can usually be accessed at 55 unless there's a terminal medical condition, right? So it is slowly increasing up to 57 in April 2028. So that's something to be mindful of. Whereas in Australia, to access your super, it's a little bit more generous. There are what's known as conditions. So I'll list them here, but you'll be able to actually see that if you were to hold certain life insurance policies like salary continuance, income protection cover within your super, you'd be able to access the benefits because they'd be paid into your super, and you'd need them to obviously maintain your lifestyle and your medical treatments, etc. Now on to tax on earnings. So in the UK, it's simple. There's no income tax, there's no capital gains tax. That brings obvious advantages and means if you want to switch investments, it's not going to have a negative impact at all from a tax angle. And obviously it can grow that little bit quicker because it's not being nibbled away by the tax man. In Australia, during the growth phase or accumulation phase, it's taxed at a maximum of 15%, right? There is capital gains tax that does get applied too. Now, if you hold the asset for more than a year, the capital gains tax is reduced to 10%. What is a little bit different is that the super fund can claim certain tax deductions and tax credits to try and help minimize the 15 or even the 10%. Now on to employer contributions, right? So in the UK, with their particular pension, an employer must pay 3% to eligible employees. So they've opted in. The actual employer will put in 3%. The employee needs to pay in at least an additional 5%. So 8% of their salary goes into pension, right? And there's no set maximum contribution. Now, within Australian superannuation, the minimum is a 10% and what's called a superannuation guarantee contribution. And there is actually a maximum there that the employer has to put in. So tax reliefs as well as tax on contribution. So within the UK, there's no tax applied to putting money into a UK pension. None at all. In fact, you actually end up getting 2 bonuses by putting money into your UK pension. So 20% of the contribution is added by HMRC or the UK government onto the amount that you've put in there. And so that's obviously quite generous, a 20% return. And then your basic rate tax band will be extended by the amount you've contributed. Now that second benefit is huge because as an additional rate taxpayer, for a higher rate taxpayer, that will work out to be a 20% tax saving on that money. And for additional rate taxpayers, that'll be a 25% saving. So that's huge. But the news is even better. So if somebody's earning just over 100,000 or up to £125,400, they're able to get what's called their personal allowance back. So that results in around about a 60% tax savings. So we're going to do another video on that. If you're interested, put it in the comments below if you want to see it. If not, let me know also. But it's a huge tool that you can use to recover your personal allowance as well as some tax savings there. Here's a really important point though. If you get your sums wrong and you write to your pension provider requesting tax relief, your pension provider will take your word for it and will apply the tax relief and get the money from HMRC or the UK government. When HMRC do their review, they will recover it. And so that again can become quite a rude shock. It's not the pension provider who's the gatekeeper there. It's really a case of you need to do your sums and get that right. Australian superannuation, if you were to make a pre-tax contribution, what will happen is the super provider will take 15% tax out of your super. There's no tax taken from those non-concessional contributions or the after-tax contributions. Now, as I mentioned before, low income earners, so if you're 41,112 Aussie dollars or less with low super balances, so see in the comments below for details of what's considered a low super balance, can get a maximum government co-contribution of $500 from the $1,000 after-tax contribution. So therefore, you'd get $1,500 added to your super if you met that criteria, which needs to remain there until retirement or you've met a condition of release. So tax on your retirement benefits within the UK. So within the UK, 25% of it is tax-free. However, you do now have various ways to access your pension, such as flexible access drawdown or flexi access drawdown. Previously, it was annuities and that was it. But this allows you to be strategic as you can take as little or as much as you need. So you can really take advantage of all the different tax allowances and make sure that you can either minimize or even eliminate further tax. The other thing that's really important is that it's considered as exempt from UK inheritance tax, which is a whopping 40%. Now, with Australian superannuation, 100% of it is tax-free. So as we talked about before, if you've got that general transfer value, that 1.6 to 1.7 million currently, and that's moved across from accumulation into this pension phase, and you're an Australian tax resident, so you're back in Australia in the form of an annual income stream or partial or full lump sum. If you are fully retired at 60, you're able to get that 100% tax-free. Once you've hit 65, it doesn't matter if you're working or not. Now that is gradually increasing up to 67, so just be mindful of that if retirement's just around the corner. Now it is important to note, if you intend to remain in the UK and draw on the Australian superannuation retirement benefits, you need to have done some careful planning before you do, because HMRC doesn't necessarily recognise the Australian super having that tax-free status, and you could end up with a UK income tax bill. So there is some confusion around double tax arrangements and how they work between Australia and the UK, but broadly speaking, it's for that ambiguous period of when there's overlapping tax years during a move is when the majority of that comes into play. It's beyond the scope of this video to go through that double tax arrangement in detail, but it's a really complex area. So you do need to make sure you've got that covered off. So a common question I get asked by clients and even some Australian financial advisors is, what are safeguarded benefits? Well, these are unique benefits associated with a UK pension plan. They're also within some Australian supers, but the UK tend to have a lot more of them. So most people would be familiar with defined benefit schemes. Now, they will provide you with a guaranteed minimum pension or guaranteed income, right? So that's a huge benefit that you wouldn't want to lose. Another common benefit is protected tax-free cash. So normally there's a lot of Australians that draw a blank when they're told that they've got that within their pension fund. Well, some of them are able to receive 25% tax-free cash of a larger sum than what the current lifetime allowance is. And as you can imagine, some of those are 1.5 million, 1.8 million, and it's 25% of that figure rather than the 1 million figure. So it's considerably higher, and you wouldn't want to miss that benefit by just quickly consolidating the actual pension funds. Another major benefit that's written into some of these policies or UK pensions is what's called a protected retirement age. Now, this refers to some pension holders were able to access their pension from age 50, right? And instead of having to wait until 55, or now it's actually creeping up to 57 in 2028, you're obviously going to miss out on that benefit of being able to access it early. You might not necessarily want to, but it's nice to be able to have that option, and you could be giving that away by consolidating your pension. Now, while we haven't covered everything, I hoped it helped you understand the fundamentals of how they both work. If you haven't already, smash that subscribe button to see more videos like this. If you have any comments about the content, the best bits, what you liked, what you'd like to see next time, please let me know. Have a great day, all the best, and I look forward to seeing you again soon. Thanks, guys.